Alright, what's up guys? It's Jeffrey back with another video, and today we are going to be talking about 5 steps to finding profitable trades in the Forex markets. Alright, so let's get started. So step 1, start on a higher time frame, monthly, weekly, daily, and 4-hour. So a lot of people that get into trading get caught up on the lower time frames like the 5-minute and 15-minute, and those are good time frames to use, but specifically for entries, not so much doing your analysis and seeing where price is likely to trade into. So you want to start on a monthly, and then you want to break it down from there. And if you watch my video yesterday, then you would see basically what I'm talking about, from breaking it down from a monthly standpoint down to a 4-hour or 1-hour, and then you can use lower time frame for entries. So after you have broken it down from your higher time frame, so you've done your higher time frame analysis, you want to wait for a break of market structure before finding your entry. So whenever the market trades into your level that you're anticipating, so whether that be a support level or a resistance level, whenever it trades into that level, you're not just going to immediately enter the trade. You're going to drop down to a lower time frame, so the 15-minute or the 5-minute, and you're going to wait for a break of market structure. And once you have the break of market structure, which I'll explain in a few slides, but basically you're just looking for the market to change direction, right? So if it trades into a level of support, then you want to see higher lows and higher highs forming. And if you see that, then you know that the buyers have stepped in, and you can basically take your trade then on a break of market structure. But you want to enter your trade on a down candle trading back into the market structure. So you're looking for a retest. So move to a 1-hour time frame to frame your risk to reward on the setup you're anticipating to take. So after you already have your higher time frame levels marked out, you can drop into an hourly time frame, and then that's where you can frame up your stop loss and where your take profit's going to be. So you're just framing that on the hourly based off of the levels that you've already outlined on the higher time frame. So use a 15 or 5-minute to place your trades, like I was saying, and place your stop loss under the previous swing high or low, and trail it as your trade goes into profit. So once you enter your trade, you're going to want to place your stop loss not below the swing that you've just taken the trade on, but below the previous swing low or high. So it'll be within the range. Alright, so here's an example, and if you look, this is on a daily time frame. So you can see that we've got a bullish market, and we know that because we have higher highs and higher lows being formed. So when we see that, we know that we're in a bullish market. So the blue dots are signifying higher lows, and the red dots are signifying higher highs. And if you look, I marked out the red box that says lots of people sold here. So all that just means is that's previous resistance. So you can see the market traded up, found resistance, traded up, found the resistance, traded up again, found resistance, and sold off. So the market would likely want to go back up there. So once we've identified the market that we're in, we can move to a lower time frame to frame our trade. So now we're on a 4-hour. So if we look at the 4-hour, you can take a look at the first set of dots. And I don't know why my clicker doesn't show up on the screen, but I guess this will have to work. So the first blue dot, and then you see the first red dot. Well, the second red dot was the break in market structure. So I drew my fib from those down candles before the push up of the break in market structure. So I anchored my fib there, and then you could see it traded back into the fib as well as the down candle before the push up, where I put should find support, which is a ICT bullish order block, and then it traded higher from there. So even if you missed a trade on the 4 hour, you can always take trades on a lower time frame, which typically give you a smaller risk because you're in sync with the market, before the move even happens. So looking at the 15-minute, we're looking at the same chart, same pair, we're just on a lower time frame. So you can see right there we have the break in structure, and we're only risking 20 pips for the first target of 63 pips. So that's 3 to 1 just on that, but we're targeting longer term the red box where lots of people sold. So you can see there we had another break in market structure, just like we did on the 4 hour. We had a break in market structure on the 15-minute, and then we had the retest right there where I put enter on retest. That's where I would have entered on that down candle before that push up. So a lot of times when going over this in hindsight, you're looking at it and then, or even looking at it while the market's moving, you think, oh shit, well, I've missed a setup. Well, it's not about, missing the setup, because the setup is always forming. You just have to be in line with the market. So if you missed a setup, wait for another setup to form before entering the market, just out of revenge trading or just FOMO, like you're scared that you're going to miss out on the move. There's always going to be a move, so don't be afraid of missing the move. If you can see the move, then you're learning. So a second opportunity on the 4 hour. So you can see if we missed that first opportunity, we had the second hour, which is the next set of pink and blue dots. We traded up, we broke market structure, traded back down into the fibs. We didn't quite hit the down candle before the push up or the breakout, but we did come back down into a logical level, formed a higher low, and then made a higher high. So that is a potential second opportunity. And then, so breaking down the same chart, we're looking at an H1 now, so an hourly time frame. You can see it didn't trade into the 4 hour down candle, but if we look at it on an hourly, it did trade into that gray box, which is the down candle, which made that higher low, and then from there, it took off. Alright, so we can see, again, price is at a higher time frame level. We know it's at the logical 4 hour and 1 hour level, right? So looking at it on a 15-minute, we can see the down candle formed, and then we had a break of structure, then it dropped back down into that down candle. So that could have been another potential entry. And then from there, we rallied again. So what I wanted to get across in this video is it doesn't always matter if you miss the trade. Where a lot of people mess up is they'll go in revenge trading after they've lost or made some money, and they just try to go back in the market, and that's not what you want to do. You want to plan out your trades, you want to wait for it, be patient, let it come to you, and then you enter the trade. So, and then going back and studying things like this and the charts, you'll be able to see it before it happens and also as it happens. So that's it for today's video, guys. Make sure to like the video and also subscribe if you're watching this on YouTube. That way you will see all the videos that I post. I'm going to try to do this every day for you guys and provide some sort of information or value to you guys. So leave a comment down below or leave a comment really with what helped you the most in this video, and also if there's anything that you would like me to talk about in my next video. Thanks guys, have a good one.